Welcome to another exciting exercise. This one is going to be on identifying and analyzing financial statement effects of stock transactions. Be advised that this may be more than one video because we're going to have three different requirements. Here we're going to use what we call a financial statement effects template. We're going to make some journal entries, and then finally we're going to use some T accounts. So if the video starts getting too long, then we will stop it and do kind of a part two. So looks like what we have going on here is we've got a company called Lipe, and they have some transactions related to their equity financing or stock. Okay, so whenever you if we're talking about bonds like we have previously, that's when a company takes on debt. However, a company can also issue stock, whether it's common stock, preferred, etc., and they can raise money that way. And whoever invests becomes an additional owner. So that's what we're going to be dealing with. So let's look at this. As on February the 20th of the year, the company issued 10,000 shares of $1 par value common stock at $25 cash per share. So what we have to understand here is that we're using a financial statement effects template for part A. So there's going to be some detail that we're missing with this template. We're not going to really break things down perhaps quite as much as what we would if we were doing a journal entry or even T accounts for that matter. So all we have to do, let's bring our calculator over here. And right about there should work. And we've got 10,000 of these shares that were issued. Always remember this word issued. Whoever is issuing is the one getting the money. So if we're issuing stock, we're getting cash. Well, usually we're getting cash. In this case, certainly we are. And if you buy a house and you borrow money from the bank to do that, you're issuing the bank a note. It's not the other way around. Okay, so make sure you always know what this word means. Okay, so 10,000 shares, and all we really have to do is just multiply it by the $25 share price. And if we do that, we come up with 250,000, and I'm going to try to squeeze this in here. I'm going to omit the dollar signs. So we've got the cash asset going up, and then stock is contributed capital. Now that contributed capital is actually in two parts, but we'll get to that here in a little bit when we get to the journal entries. February the 21st, we're going to issue 15,000 shares of $100 par value, 8% preferred stock at $275 per share. Okay. So we're issuing again, so we're going to be getting some money, especially if there's cash involved. We have $100 par value. This 8% here, we don't really have to do anything with that right now. That's just the percent dividend that is paid, well, supposedly going to be paid on the preferred stock that is issued. So we don't have to worry with that right now. We need to worry about the 15,000 shares, and we need to worry about the 275, just like we really like what we did in the previous example. And this might be very difficult, so I'm going to write 4,125,000 here, and again for contributed capital. So the only difference in these first two transactions is that we have two different types of stock. And so of course, common stockholders, they're eligible for stock splits. which can be beneficial. They also get voting rights. Those voting rights don't really mean a whole lot unless you're a major stockholder. But remember, preferred stock, preferred in what way? Well, preferred as to dividends, right? So if the board of directors comes out and says we're going to pay $1 million in dividends, these folks get as much of that million as it takes to satisfy the 8% dividend before the common stockholders would get anything. But we don't have to worry about that right now. I'm just, I try to interject a little bit of information in these videos because I don't know that you're actually going to watch all of them. Okay, so on June the 30th, the company purchased 2,000 shares of its own stock, its own common stock, at $15 per share. Okay, and this is something that companies will occasionally do, and we call that treasury stock. And so what we're going to be doing is we're going to be using something called the cost method for accounting for treasury stock. And so what this means is the company has issued some shares up here, for example, of common stock. Now they're going to buy some of those back. So they're actually going to repurchase these shares of its own stock from the investing public. And they can do that to help temporarily prop up the stock price, or maybe pay it out as bonuses to the CEO and these kinds of things. So we're going to take the 2,000 shares and we're going to multiply it by $15. So this could be a situation where the stock price, we're doing this to prop the stock price up a little bit, because notice we were issuing some stuff just 4 months earlier at 25, and now we're buying it back for 15. So what we want to do is we want to recognize that we have $30,000 cash going out, and treasury stock is not contributed capital. It's not earned capital. Instead, this is what we call a contra equity account. So this actually, treasury stock actually has a normal debit balance. So that's the opposite of common stock, preferred stock, paid in capital type accounts. Those have normal credit balances. So anytime we use the word contra, we're using that as a reduction account or as an adjustment account for something. We could use that for example, for depreciation, to adjust the historical value of, well, we don't adjust the historical value, but to adjust the gross value to the net value of our long-lived assets. And we're using it the same way here. So the company now owns $30,000 of treasury stock. Again, treasury stock is the company's own stock that's been repurchased. September 25th, sold 1,000 shares of the treasury stock at $21 cash per share. Now, don't be confused. We do not have any type of a gain here. That would be illegal. So what we have to do is we have to say, okay, we're going to sell 1,000 of these. We're not issuing them. We're selling them this time. And we just take the 1,000 shares, multiply it by 21, okay, and that's going to give us 21,000. And so that's going to take care of the cash portion of this pretty easily, all right? But again, I said we were using something called the cost method. So what we have to do is we have to adjust this contra equity account not by 21,000, but by 15,000, or 1,000 times 15. Okay, so that's what we're going to do. So this would be a negative figure here. All right, and we also have to recognize that we are going to essentially have a $6,000 increase here to contributed capital. And that's going to be from something, and we'll get to this in a minute when we do the journal entry, but that's additional paid-in capital from the sale of treasury stock, sometimes just called additional paid-in capital. Just kind of depends on who your teacher is and so forth. Okay, so that's all we actually have to do for Part A. So we'll clear this out and push this up a bit. All right, and then it says that we're going to prepare journal entries for these transactions. So let's see here. Don't really need the calculator for journal entries. So we're going to start back here with this February the 20th transaction. And we've got the figures right here, 200. We might actually need the calculator now that I think about it. So we know that this was a $250,000 transaction. And we know also that cash was debited for $250,000. However, we need to understand that common stock, which has a credit balance, this is going to be for common stock is going to go up by $10,000, and that is based upon 10,000 times 1, the $1 par value. Okay, so only the par portion of the issue price is allocated to common stock. The rest is going to be additional, well, you know what, I better start abbreviating because I'm not going to make it if I don't. Additional paid in capital. So sometimes you might abbreviate that as APIC. This will be a drop-down box in the homework. So additional paid in capital, and then we want to indicate that it is for common stock, and that is just going to be for the difference. Okay, for $240,000 or for $250,000 minus 10,000. Okay. Then on the 21st, our cash amount is exactly what we've already calculated, and so we took this 15,000 and multiplied it by $275. That gave us 4,125,000. So again, we need to put cash here, and then that's 4,125,000. Okay, now we have to do the same thing with the preferred stock. We have to take the par value amount. So let me move this over here kind of right there. That's probably good. 15,000 shares. Let me go back here. 15,000 shares right here times a $100 par value gives us $1.5 million. And so that's how much we're going to credit preferred stock for. All right. And what we can do is we can take our cash received minus the portion of the sale or the issue allocated to preferred stock at par. And so that's going to give us the exact same account that we have up here with one exception. So I'm going to abbreviate additional paid in capital, but this time I'm going to put preferred stock or PS. And that is going to be for the difference that we see on the calculator, $2,625,000. Okay. All right, and then on 6/30, let's see here, we purchased, this was the one where we purchased 2,000 shares of our own stock for $15 per share. So treasury stock is going to be our debit, okay, and that's going to be $30,000. We now have $30,000 in the Contra Equity account, treasury stock, and our credit is going to be cash for the same $30,000, and that's all we have to do. Then we're going to sell to the investing public 1,000 shares, or to somebody, 1,000 shares at $21 a piece on the 25th. So cash would go up. 1,000 times 21 is $21,000. Okay. Our treasury stock is going to be reduced, but again, we have to do the same thing that we did up here. So we're going to credit treasury stock for 15,000 because again, we're using what's called the cost method. All right. And then we can actually put additional paid in capital, and I'm just going to put TS. It would actually be more appropriate, additional paid in capital from the sale of treasury stock, and this would be for $6,000. All right, so we got the 6,000 in there, and then there's a part C to this. But I think what we're going to do is I have another scenario that I'm going to make a video on for how to do this with T accounts, because this video is already over 16 minutes. So we're going to wrap this up. Again, we covered the financial statement effects template and the journal entries, and then we're going to do a separate video with different numbers, different scenario up here for the T accounts. All right, thanks for watching.